I want to take a few minutes to redo a little bit of what we covered yesterday and maybe kind of emphasize a little bit more on what we covered late yesterday.
Thank you, Raj.
Okay, gross margin. The reason gross margin is basically the measures a company's profit compared to its revenue in a percentage manner. All we want to see is what percentage of that of the company's revenue is the gross margin. The higher this, the more capital you're making. What do I mean by that? We need to be able to see if you are making money on the top line of the business between the cost and the revenues that you're bringing into the company. Now, a lot of business owners look at the total net profit, which is the bottom line after all expenses. This is the midway step where you look at where, based on your revenue for every dollar, how much of it is directly associated with that sale, everything that is associated with that sale. So what we want to be able to kind of judge is another way of looking at this number is also called contribution margin. How much of this margin is being, how much of this dollars wise is contributing to cover all your overhead, because that's what you need to cover. You have rent, light, insurances, all of that. So we want to know how much of that revenue, after you take away the direct cost, is available for overhead. Now, why is overhead, and how do we control that? Depending on the top margin. Sometimes we can find out that, hey, I need to increase pricing. I may increase revenues. I have to do something on the top line so I have more money in the bottom to cover. You can't sometimes adjust rent, insurances, all of those. Those are the fixed costs of doing business. That is your cost of doing business. I can't change that. I may be able to modify a little bit, but I cannot change that. What I do have control as an owner of the business in retail or any business is that middle section of cost and revenue. I can adjust costs. I can buy cheaper. I can charge more. I can sell more units. I can do whatever I need to do. Those are the top two segments of the business. So after we covered this, I know you got the exercises, and we're going to cover that today. We're going to do that right now, even though I want you to I expanded it from what we did yesterday. I did expand it a little bit more to kind of include these columns, okay? What is gross margin? Again, gross margin is whatever your sales were. Let me annotate, use the annotations here. Okay, 1 second. Whatever your sales were here, and I subtract the cost of goods sold right here. That gives me $123,000. That is in dollars. In percentages is this. So what I did was I took this 123 and divided by 162. That's the percentage. Okay. So this is what I had available to cover all of these costs. So if I wanted to raise my salary or wanted to hire somebody or something like that, I have $123,000 to play with and use. So as you can see in this this example, the owner did not get any salaries. But year 3, she got a salary of $15,600 with a payroll tax of $1,200. So this is how she's been able. Now she was able to hire other people to help her doing the business. Even though her expenses were higher, she was still able to make a profit. So if you wanted to look at for the gross margin, well, I did it the gross margin. I did it for 2 years. I'm sorry, the gross margin is 76 1 year and 80 for 2021. I didn't forgot to do the third one this month. Okay, but that's how you look at that number. Even though it's coming down, that means why is it coming down? Because maybe some of the products she bought starting to cost her more money, or she's giving discounts. We don't know exactly based on this number why she's dropping from 80 to 76. But she dropped. That means either she's giving more discounts here or some of this costing her more money. And these are the areas that you can control as a business owner. This side is very difficult because it's fixed costs. It's very difficult to make changes. Not saying that you won't make any changes, but it's very difficult to negotiate this. This one is quicker and faster to make a change. So sometimes when you look at it from a perspective of, hey, why are we, and in the example we did with a cup of coffee, which we're going to cover again today, it allows me to see what is my margin to increase a little bit the price. We went from $2 to $2.25 a cup of coffee. That increase will affect this number. When in the same example, we dropped the price by 5 cents to every cost of every product, that is adjusting this number. The rest stays the same. It's very difficult to change, but this is where you're going to start making money. This is where you need to make money. Okay? And this is the area you want to control, which is right up here in the revenue and in the cost of goods sold. Any questions on this? Because we are just touching the gross margin portion of it. Okay, what is the overhead percentage? This is the overhead.
Sorry to interrupt. We do have a question
okay.
In the chat. Stacy mentioned, is it gross profit divided by total revenue to give a percentage?
The gross profit divided by total revenue, correct. So you take this number and you divide it by 162. And that gives you 76%. Overhead percentage. I think so. The lady with the alfajores, was it Fabiola? She had a question on overhead and how to calculate the cost of overhead into the product. You do not. You do create it as a percentage. In this case, you look at it 51%. That means for every dollar that I bring here, 24 cents goes to this. 76 cents is left over. And I have to spend 51 cents in running my overhead, leaving me 25% as a profit, 25 cents. Okay. So that's the way you look at it. It's how much in cents or in every product. So if you're selling something for $2 or $3, you know that 24% is going here, 76% is left over, 51% is being used by all of your other expenses and giving you a profit. So when you're running your business and you're looking at quick numbers, you're not looking at all of these numbers. All of these numbers don't make sense to you. I don't care. All I care is this number, this number, this number, and this number. I need to remember and look at 4 numbers. That's it. All I have to look at 4 numbers. I can do this at the end of the day. I can do this at the end of the week. I can do this at the end of the month. How frequency you want to be able to look at your number. This is the number I'm looking at. These are the 4 numbers. This is where they used to say managed by the numbers or management by numbers. You're looking at 4 numbers. 1, 2, 3, 4. All of these things, yeah, they make, but they're in dollars. Why do we want to confuse our world in looking at it? Remember these four numbers. And once you have these four numbers, guess what? You have created your own financial model. This is your financial model of your business. And you could have two retailers in exactly the same business. The business model is different. Because one might be giving a little bit more discounts, one of them a little bit less discount, has different overheads and different things. We don't, all of those nuances can affect your business model. You need to find what is your business model specifically. It has to be for you. Now, once you know this, you may not like the picture. Agreed. You may not like the picture, but now you know where you got to fix it. Do I fix it here? Do I fix it here? Or do I fix it down here? And then you can start looking at where I need to look at. That's this portion, or this portion, or this portion. So Stacy, I like your observation yesterday, which was very good. I was commenting earlier today. I changed it to net profit before taxes because obviously everybody was looking at it from an operating. But I commend you for catching it and asking for the difference. Though it's still the same, but you caught it. Okay. So, hands to you, for catching it. That's great. For everybody, this is the one we want. Okay. Any questions on this topic right now? Because we're going to go into the next topic of yesterday. Are we okay? Yeah, go ahead, Stacy. Go ahead.
Okay, Raju. Well, I just want to make sure that because they always say you need to know your numbers.
Mhm.
And so the four numbers that you're saying that we need to make sure we know is the total revenue, the cost of sales, gross profit, and the total expenses.
Well, you have your total revenue, obviously $1. I mean, this is always 100%. Always, whatever you sold is 100%. If you sold $100,000, then all of these numbers will change based on that $100,000. So you're looking at this number. Obviously, this is your total number, but you're concentrating on this,
Net profit, expenses, and net profit.
Right, before taxes.
Okay. All right. Thank you.
Okay.
Hello, a question.
Go ahead. Who was that?
Yeah, it's Omar. But then when you see the total sales, those total sales also includes the sales tax, because sales tax is usually nothing. It's not
Well,
money
you're not
that you are.
supposed. Sales tax is not sales for you.
Oh, that's correct.
You're just taking that money and putting it aside because that belongs to the state. So sales tax is not part of your sales.
So then but usually when the reports come in frequents or QuickBooks, usually you have that total sales, including sales tax. There's a
Well, then the problem is somebody did not set it up properly.
Okay.
Okay, it's not supposed to be counted. Even in QuickBooks,
okay.
It's not counted. That means your setup is wrong.
Okay. Thank you.
Okay. Trying to. Okay, I'm going to clear everything. And then we go to the next slide, which is break even. This is the formula for break even. Again, let me do the annotation here. It's fixed cost divided by the price, and the variable cost will give you the break even point, which is the same as I talked yesterday, which is the fixed cost you divide it by your gross profit. This is your gross profit. Okay. So these two are exactly the same. It's just once you have this, you already have your gross profit. So you just take the fixed cost and you divide it by the gross profit, and you got it. And these are some of the key points that you need to have when you start doing either projections or wanted to do a lot of what if scenarios and any benefits that you can do or any scenarios that you want to play. You need the estimated fixed cost, selling price, unit sales, and variable cost. As you may remember, we did that cup of coffee sample, and we saw how it was broken down in exactly the same way. Okay. Are we okay on this point? Now we go to the next one, the benefits. Why do we even look at break even? Why do we even want to take all this time and calculate? Because it allows me to do a better pricing. I'm able to hone in on the price I need to set. Obviously, it's going to tell me if I miss any expenses. Oh, I forgot to add this. I forgot to add that. Allows me to set targets. Hey, I need to sell so much. I have to use so many. I have to sell so many units. I have to sell so many per square foot or what, however you're calculating your revenues.
Raju, I'm so sorry. Before you move on, we did have a question in the chat.
Oh, okay.
Martha, she said, what should be the profit percentage of a business after taxes? Does it go well beyond the break-even point?
What should be the profit percentage of a business after taxes? A really viable business that goes well beyond. Again, break even means that you did not make any money. That means your
I'm sorry,
revenue.
Raju. I'm
Yeah.
sorry. The question is this, because in Spanish is better, para que tú puedas entender qué es lo que quiero preguntar.
Okay.
¿Cómo puedo saber, cómo puedo saber cuál es el porcentaje para mirarlo rápidamente en un negocio, ¿no? Veo los porcentajes, ¿cómo puedo saber, ok, este negocio cuando está en este porcentaje está mucho más arriba de su punto de equilibrio? Porque realmente queremos negocios que vayan más arriba del punto de equilibrio, ¿no? Que realmente sean viables y generen ganancias. Entonces, si queremos proyectarnos como mucho más arriba del punto de equilibrio, ¿cómo podríamos saber cuál es un buen porcentaje para estar fuera de la zona de riesgo?
Bueno, maybe the best way I'll translate what
Sí,
she's
yo
asking.
voy a usar el traductor, pero quería hacer la pregunta en español.
Okay,
Pero voy
I'm
a usar
gonna,
el traductor.
okay. What she's asking is at what point, what's the level that you need to be at above break even to make it a good business? That's a very difficult question because it goes by industry. I cannot calculate one that sells a retail of how do I call it, jewelry, as opposed to somebody who's selling clothes or somebody who's selling electronic goods. So even within the retail, if you look at your retail, it's very difficult and very different, or with food, or with other things. So a lot of it will depend on your industry and where you're located also. So I will cover benchmarking, which is part of today's session anyhow. When we do projections, we will cover where you can get information on that. Some of them, one of them is free. The other ones you have to pay to get that information, but one of them is free. And you can see, depending on which business and which area and things like that, you will get something available saying, okay, this is what it needs to be. This is how much the gross margins are. This is what the net profit needs to be and all of that. It will give you some indication. Now, I'm not going to tell you, if it works for your business or not, but it will tell you by industry. Okay, so at least you have some idea of what to look out for depending on your industry. Okay, or the segment of the retail. Okay, so obviously looking at break even, you're looking at, obviously you want to be way above your break even. If you're break even, nobody's interested in your business and you're not making any money. That's not what you want. You want to be profitable. For you to be profitable, you have to be above break even. That is a must. And we're going to run with the example of Zen Flower Shop, and we will work on it and see how you calculate the break even of those companies. But basically, what you want to be able to be above break even. The higher, obviously, the better. Okay. But these are the three pieces of benefits that you need to be able to, as a small business owner, you want to make, start with. If you get these three main benefits out of your business initially, you're on the right path. Okay. So let me go back. So this is in a graphical form. Like I said, this is your total cost. This is your revenue, and this is your break even. This point right now, it can be in units, it can be in time, and or pricing, however you want to look at it and set it up with. You can get that break even point. And we are going to do it now. And the next slide is on the coffee shop the coffee cup that we did yesterday. So I wanted to go over it to make sure that we covered all of those different points that we covered yesterday. Okay. Adjusting the sales. It's a cup of coffee, real simple. You're looking at the price at $2 per cup. We are selling 3,200 units. We bring in $6,400 in revenue. We have food costs, the cup, other supplies, the sugar, the stirrer, whatever you want to buy. It costs 65 cents. Okay. It's costing you 65 cents. You brought in $2, 3,200 units. Your cost, variable cost is 65 cents, and that's equal to 2,080. Your gross profit is $1.35 out of the $2 that you have, leaving you 4,300. Now here we put all the fixed costs, the rent, the car lease, the transportation, insurance, any other costs you may have. Totals $4,300. As you can see, this breakup, the way it is set up, made zero. You broke even, you didn't make. So it is after you have your sales. I have to deduct the $2,080, and I have to deduct the 4,300, and I get zero. That's how I come to my break even. It's not making money, but I'm not losing money. Obviously, at this point, you do not want to be. This is not the place you have to be. You want all of these numbers to be plus. And more plus you have, the better off you are. Okay.
Raju, how do you do this when you have like 20 or 30 different products?
It's tough. So what happens is, in restaurants, the way you do it, you may have a menu for lunch, breakfast, lunch, and dinners. Okay, you may have for drinks. So you have different ways of putting it, but you can't do it for a menu. Now, if you're going to introduce certain type of special menus or things like that, yeah, then you want to do it for those specific items or menu that you want. If you have most retailers, depending on the products that you sell and everything, use Keystone. A lot of people, does everybody understand what Keystone means? Keystone is you double it. If it costs you $1, you sell it for $2. It costs you 10, you sell it for 20. You're just doubling your money. It's just Keystone. Now, a lot of business cannot function with that. They have to make a lot more, otherwise they're not going to cover it, because they do not have the sales volume to cover it. Jewelries have to do more than double, more than Keystone. Okay, they have to, because not everybody is walking in to buy a diamond ring. okay? Or diamond necklace and all of that. That's not going to happen, okay? So they do have to make more than keystroke. They have to make 2 to 3 times, 2.5 to 3 times minimum, okay? Now, they may choose certain product. Oh, this earrings, I'm going to give it at a discount, or I'm going to do that. That's the same way the logic is. Okay, so depending on what type of volume and price you are, it may make a difference on where you're going to be in sales, where you're going to be in pricing, and where your net, what you call your break even is going to be. So we're going to change it a little bit. I'm going to sell 4,000 units. My goal is to sell 4,000 units. I'm going to keep it at the same price. Okay? I'm going to push. I'm going to do whatever I need to do. And I'm going to sell 4,000 units at the same price, $2. But now I made $8,000. My cost is still the same, 65 cents. Hasn't changed. But my dollar amount changes because this is 65 cents out of that $2 that goes for me to do that product. My cost is still the same, hasn't changed, 4,300, but I made a profit of 1,080 by selling 800 units more, from 3,200 to 4,000. Okay.
Okay.
Now I'm going to.
I have a
go ahead.
question. Just going back to the last question. So would it be recommended to say, for example, I have one product that is on average $16, but I have another product that's on average $200. So would it be wise to look at the percentage of sales? Like I sell 40% of my total sales, 40% of the items sold are at an average of $200, and 60% of the items I sell are at $16, and then finding a break even like that, because if I find a break even for the $200 items, it's very skewed, right? Like, and it doesn't give me the whole picture because I don't sell that many to break even.
Right, but see, now when you have product like that, the way I would work it out and I would suggest to you is, okay, the $200 item will have a 200 here. It will have a certain amount of units here. It will cost you a certain amount of cost here. And this is where I would stop.
Okay.
Your overhead is distributed among the dollars that you sell 40% and 60%. So your overhead is going to have to be spread between all of your units and product. So what we do is I would stop right here. This is what I have as contribution margin, which is the other topic, the other name for it. And this is what I have available from this product to cover a lot of other products. Because mind you, I'm using this simple example, but what happens if I tell you, well, I also sell tea. Okay, but this is just for coffee. I may have another product, tea, or Cokes and things like that. I may have. So what happens is I will not include all of it. I will look at the 5,400 plus what I bring in by the Coke, by the ones that I bring by the tea or sandwiches that I do, and they all contribute a certain amount of money to help me cover all of this.
Okay.
Make sense?
Yeah. Thank you.
Okay, now I'm going to make a change. The new change that I'm trying to show here is I raised the price 25 cents. I'm selling 4,000 units. I'm going to sell 4,000 units. I just made a change of 25 cents. Okay. I was able to, because I'm selling a little bit more, I'm able to negotiate a little bit my pricing. It went from 65 cents to 60 cents. Just 5 cents, a small percentage. Guess what? I made my cost for those 4,000 units came down compared to the previous, and I made more money. Remember, this one was $1 $1.35, now it's $1.65. So I made 30 cents more per cup. I made more money. My cost is still the same, hasn't changed, still $4,300. I just made more money. And when you look at the price increase, it's not a big. You see the price decrease on my cost is not big. You're dealing in percentage, small pieces. And that's what you need to look at. You're not going to make a wholesale 10% here, 20%. It's very difficult. And when you start looking at your numbers, you need to start thinking, hey, I'm going to get 2% here. I'm going to get 5% here. I'm going to get 3% here. And all of those pieces will add up a big chunk. Make sense? Are we getting it better than yesterday? Yeah, Stacy, thank you. So going back to this, now we're going to do that exercise from break even. Okay. Based on these numbers that you saw here, okay. And this is the break even point, the way we, here's a formula. Somebody wants to do it, a quick math. What is the break even for 2022? Paula, Stacy, help me out. Yeah.
In the meantime, Raju,
Yeah.
Sibley had a question. She said that she wants to understand if the key is to sell more units or to increase the retail price of the items.
Well, you can, the goal of every business is to make money. And the combination, whether you're selling it at what price, obviously you cannot sell the same product more than what your competitors are selling it, because you're not going to sell anything. They're going to go to your competitor. So you have to look at it, how many units and how many things. I'm going to give you my personal example. I have personal clients. I do with SBDC, but I have 3 or 4 clients. At one time I had multiple clients. I have 4, so all of them pay me more for those time that I give them. So I only have to deal with 4 clients. You take another accountant, they got hundreds of clients. You take other accountant, they may have 50 to 100 clients. Other ones will have 300-400 clients. Why? Because depending on the price, and this is just accounting. Okay, so the key here is how much. Like my example yesterday, I told you about my grandfather. That's how I learned at the age of 8. Gross margin. He wanted everybody to sell the same product for the most. That was his way of looking at it. In today's market, it's a little bit more difficult. In the 50s and 60s and 70s and 80s, you could get away with it. Now it's very difficult because I have the internet. I have multiple choices to buy the same place. So you have to find a equilibrium, how much you need to sell or how many units and then what price, okay? And that's part of your projection that we're going to cover later on today, how to calculate that, how to look into that. And this is a what-if scenario. You want to work smart, not hard. Yes, you still have to work hard initially to get to a certain level. But after you get a certain level, you want to be smart about how you're going to keep growing. And sometimes it's the pricing and the promotions and the incentives. And we're going to cover some pricing strategies shortly here. Okay. So anybody wants to tell me what the number is? Well, no, I don't want it in percent. I want it in dollars. What is the dollar value for 2022? Anybody? Okay, let's start it this way. What is the fixed cost for 2022? Let's identify what are the fixed costs. You look at this, what do you see as fixed costs?
$82,000.
82,000, yeah, 83,000, correct. So what is your price minus variable cost, this portion, which is your gross margin? Sorry, it should have been gross margin. Sorry. This is your gross profit. Okay.
Raju, you have some answers in the chat as well.
Oh, okay.
Jessica
I
said,
saw the break even of 67%. Yeah, that's
Gunther put in dollars, Elmer put in dollars, Jessica put in
oh,
dollars.
I didn't get that. I mean, I'm not seeing it here. One second.
So Gunther put 580 and then 82,647.
Who put 82,647? What do you
Elmer. Raise your hand, Elmer.
Okay, one second. Let me try to see if I can get the chat here. Okay, there it is. Well, let me, okay, the gross, the 82,647 is your, 82,000 is your total expenses.
The total expenses, but I suppose, what, my calculations will be 125,222 will be the break even,
How much?
the 125,222.
How do you get 25,000?
I had the 66% and then multiply
How do you get
Yeah.
66%?
dividing the total expenses, 82,647 divided by the 123,424, the gross profit. Divided the total expenses by the gross profit.
What I should have put here, I forgot to put the margin here, gross profit margin. So what you're doing is you should divide the 82,000 that you're correct, and you divide it by 76. Remember, I had to make these changes this morning. I made these changes this morning for today, okay? So what you have to do is you divide the 82,647 divided by 76%, right? And you will get 108,000. $746. So for me to break even for this, for Zen Flower Shop, for me to break even, I had to sell $108,000, 746, not 162. Because I sold 162, I made a profit. Okay?
Raju, why don't you use the text annotate
The text,
and
okay,
write the
let me-
complete exercise so everybody can see it?
Let me try to do that.
Thank you.
82,647 divided by 0.76 or 76%, sorry. will give you 108,746. Okay, that is in dollars. Okay. Now, if I want to know in units, I can do this one. This one fixed. The fixed, this will give me the break even in units. Okay, so I would take price, which is 162, minus variable cost will give you 123. So Elmer, what you did was find the unit, how many units I needed to sell. So 182,647 divided by 123,424 is 166 and 100. I need to be at 67%. What you came up with. Remember, that's somebody put 67%. Breaking is 67%. Latoya, you're correct. 67% is in percentage. That means if you take the 67%, it's the same as 108 in dollars.
Raju,
Yes.
please, can you type again that new formula for the units, like you
Oh,
did with the blue one?
Oh,
Like
this
with the
one,
text.
which is that one.
Yeah,
Okay,
that was very clear. Thank you.
okay. The fixed cost is 82,647. I divide that by 162,400 minus 38,976. Okay, will give you 60 times 100 will give you equal to 67%. Guys, everything works out of these four numbers. As you can see, I'm using only four numbers. I'm using this number, I'm using this number, I'm using this number, I'm using this number. That's it. I'm using the same four numbers I told you. I'm not looking at the individual numbers. I'm not looking at the individual. I'm not looking at any of this. I don't really, at this point of the business analysis, I'm not even looking at anything. I'm just looking at these four numbers. Okay, that's it. And if with these, I can find out what my dollar amount is. Okay, for now, how much the units needs to be. With all of this, I'm able to play with it. I mean, I'm able to, just like we did it with the example on the coffee, I'm able to be more creative where I need to be as a business as a whole. Now, just like Jessica, you may want to do this by the product line. You may want to do it by the segment of product line. If you're doing jewelry, you know, the easiest way. Okay, I will do it for earrings. I'll do it for bracelets. I will do it for different products. Or if I'm doing a restaurant, I will do it lunch, breakfast, and dinner. I might break it up that. Okay. And if you're doing dessert like Paula, you're doing it on certain types of desserts that you're using. Okay. And that's how you kind of create it by segment. Not, you can't do every product. You can if you want to, but if you have a lot of products, then it becomes complicated. Okay. Now, the nice thing is with software, it is easier today. It's not as difficult. This is all calculated automatically in QuickBooks or any software that you use for accounting. It's not that you got to sit down and do this. Yeah, you may have to do the break even, but all of these percentages and dollars and everything is provided to you. So if you wanted to sit down and do it, it will take you what, 5 or 10 minutes to calculate certain things.
So-
Raju, Aurelina wanted you to repeat something, but what I think Aurelina may have a question is that when you multiply it by 100, then you don't have the percentage anymore. You have the
Correct.
units.
Yes, thank you, Adriana. Quick question. So the break-even point is my total cost of sales.
Well, you can do it by sales, you can do it by units and time. I remember, I know now that I need to do $108,000, correct?
Correct, yes.
I know I need to do 108. So based on my projections, I can see when do I get to 108, or in the past, in this case, I can go to 22. I can see when I reach 108, after that, I made money. So I could have been March, April, May, June, July, somewhere around there. I broke even already. That's why the example of yesterday of Black Friday. Black Friday was created or came up with originally because of when they would break even in the retail in those days, the way they were calculating it. But you could be breaking even on this example, you could be breaking even in maybe in June, July, or August. So that means after that, you're ahead of the game. You can even do the break even per month.
Understood.
You can break it down by month. You can break it down by the week. You can break it down every 2 weeks. I mean, you do have that flexibility today because of technology. You do have that possibility. But what you do need to understand is the concept, what it means. You know, how often you do it is different. What I told you, when my wife was, and I have family in the retail, they do it every 4 hours. I'm not saying you got to do it every 4 hours, but they have the information and it's just a report. They go to the POS system, the retail system, and they print it out. That's it. They print it out. It's not even calculating anything. It prints it out. So the software is available to help you do that. The issue is whether you're using these tools to benefit your business. QuickBooks can give you all of this information. It won't give you the break even, but it will tell you all the numbers that you need. All these 4 numbers, you will get it from QuickBooks. You take the QuickBooks POS system, and I'm not 100% sure, but I think so they'll even give you the break even for the month, for the previous months. Or it can be set up to give you that report. Because I have a client that does a POS system of QuickBooks.
Raju, Jessica has her hand raised.
Oh, Jessica, go ahead. I'm sorry.
So if you were operating at a loss, would you still have a positive break-even point? It would tell you how many more you need to sell?
Yeah.
Okay.
That was the example I used yesterday. I didn't bring it up today because in the yesterday's example, it had a loss and they had to sell $378,000 when they were selling $350,000, $345,000. So yes, you could be off, but remember, I'm using this number.
So you can find the break-even point without any revenue. For example, if you're starting a company and you don't have any sales yet.
Right. Yes, you can, as long as you know these numbers. Okay, I can go from, I can figure out what my number needs to be here. If I know this, I know this, I know this. I don't need to know this because the logic of break even, this is 0. So I need to know this number. I need to know this number. I need to know this number, and I can figure this one out.
So it could be a good idea to do this before you like release a new product, because if the
Yes,
quantity is so high that you're never gonna get it, then you might as
Right.
well not sell it.
correct.
Okay.
Question, I'm confused right now with the, trying to get the units. In this case, units are gonna be complicated because of the different segments he sells, but if 67%, you divided the 67% by the gross margin, and that will give you a quantity, that will be the units. that you should-
What happens is this one is a little bit more detailed because I'm looking at 70. What happens is this is the price and variable cost per unit. So in the case of the coffee, it is, remember, was 0.65.
Mhm.
Okay, so this is when you're doing it by the units. And then what happens is here I'm doing it overall for dollars. Okay,
No,
the coffee was this way. Overall company was done this way. The 108 came out this way.
okay, thank you.
Okay,
Raju, I think I put the question, hi, everyone. My name is Sibley. I own Sibley Products. Sibley Product is a plant-based hair product designed to keep the hair healthy and help it to grow. Raju, I think, I mean, the number thing is really tough. I've been trying to learn this number thing for a long time. And it's very hard to really understand, but I'm working and trying to understand it constantly. I have different sizes of product, and from what my accountant does is she just tell me the cost of goods based on the revenue. But I think because my product have different bottles and sizes, some of the ingredient kind of intertwine. Do I just make the calculation on fixed costs, or just do I choose the variable, or do I just for each bottle, or just for the raw material?
well, I think so. I know, Sibley, I know we have worked together in the past. I think from maybe 5 years ago, 4 or 5 years ago, you know, through the other organizations. And knowing, I know, knowing this, as you can see here, we are looking at it from a perspective of different product lines. You see, they have revenue stream, different ones. Okay, now you could have bottle of 16 ounces, 8 ounces, 12 ounces, whatever, however you do it, and you know, and you can have different costs associated here. Okay, sometimes it's easier, just like Jessica mentioned, that we might want to do it by product sometimes if you're introducing a product, but sometimes you might want to look at it what you're already selling and see if it's profitable enough or pricing wise it's enough. Okay, so that is something that you need to do. It's more, costing is that's why I said costing is very difficult for a lot of business owners, because they look at it, they think of it as a absolute number. It's not. It is very segmented depending on all the different product and services that you provide. So it can get complicated, and I would suggest, and that's why we are here at SBDC, we are here to help you go and navigate this. This doesn't have to be a journey that you go by yourself. You can use people in the SBDC to help you and navigate these numbers and show you specifically how it works every time. but also a lot of and then some of us may be able to even help you set it up in your whatever POS system you're using to be able to manage that information properly. I have clients who do hair salons and eyelashes and all of that, and the system is set up to give them all of this information. It's not that they have to calculate anything. It's provided it to them, and it's set up that. But what my main goal here is for you to understand the concept, how you get to the number, but understand the concept also. And the concept tells you that this is what's happening. This is what's driving the numbers. This is what's changing. And if I wanted to increase or make changes in my business, this is what I need to look at. And then, yes, guys like us at SBDC are here to make sure that the reasoning and the logic that you're using helps you with your business and takes of it. You don't have to be an expert in all of the areas. You are expert in what you do, in sales or operations or the products and everything. The financial end, if that's not your strength, that's okay. Don't beat yourself to it. Just get the right people to help you with that problem, that issue. It's not difficult. Like I said, all of the fact that they can do it in retail every 4 hours tells me, or should tell you, that it's available. Okay, I'm not saying you do it every 4 hours. As long as you do it monthly, you're fine. Okay.
Thank you.
Okay. So let's move on to the next slide. Markup and margins. I want to get to what we want to take care of, the pricing. So as long as we understood that the pricing between markup and margin is one you divide by the revenue, and the other one you divide it by the cost of goods sold. That's the only difference. The gross profit is still the same, $50. Okay, that's not going to change. Okay, the margin is you divided it by revenue, just like we showed you in the gross margin. That's why the name should sound similar to you. Margin means it's coming from the selling price. Markup should come from the cost. How much am I marking it above the cost? Okay. Again, like you said, it's divided by the cost of goods sold. That's it. That's markup is cost on plus cost. The other one is on the revenue side. Let's start with pricing. All these are different pricing strategy. Mind you, it doesn't mean that you don't know your cost. You do need to do your cost. And the first piece of any pricing is to know your cost. You have to know your cost. These are the things that you need to do. Business, start low to enter the market. You will sell your product cheaper because you want clients. That's fine. That's okay. If that's where you are in the stage of your business, that's okay. But you have to reevaluate as you grow, because you are underpricing your product. You may have said, well, I'm going to sell this at such a price with a discount, but somewhere along the line, as your business is growing, you do need to make that different changes. Okay. Obviously, the product, if you're selling product, it's easier because you have a cost, product, and everything, and all the pieces are very physically available. Services is even harder. When you're doing eyelashes, or when you're doing nail salons, or you're doing any of that, it becomes a little bit more complicated because you sometimes don't have all of those features of a product available. But it can be done. So there are, again, we have to go back to cost. We always look at cost to give up a pricing. How are we going to be able to do our pricing? So obviously you have cost driven, like Aldi, Ryanair, Southwest, all of those are very value oriented, cost driven. And then you have value driven, which you have the McKinsey, the BDOs, the Tiffany's, the Neiman Marcus, the Nordstrom, all of those are value driven. Okay, they have on the larger scale. Okay. So just to understand that you have two kinds of cost structure. Okay, cost driven and value driven. You need to decide where are you in that segment. Most of us, because we're small business owners, should be in the value driven. We don't have the scalability of being cost driven, but most of us will be the value driven. Okay. Okay. This is your cost plus. This is your value plus, perceived value. You want to be able to be and use your pricing at this. This is where you want to be. Pricing your product or services. Why? Because this piece, I'm able to charge more for it. Now, how do you do that? Is obviously coming from your marketing, coming with your positioning, with your products, what you're doing to have a better perceived value so you can charge more. But if you aren't this, you became a commodity, just like every other product out there. That will prevent you from charging more unless you're able to be somewhere or be able to fit something in this segment. However small it may be, you want to have something here. Okay? The cost base, this is how you do. You have a product or you have design the product, determine what it costs you, you set price based on cost, and you convince buyers of the product value, what it is that they want. This is the price, this is your phone, it's a $200 phone, that's it, take it. But why? Because based on the cost. Now, even the Apples of the world are making sure that they're not cost-based, they are value-based. They assess the customer needs, okay? Set target, determine the cost of that product, and design product to deliver the desired value, okay? So the main difference here is, one of the key points is, from the beginning, I'm looking at the customer. I start with the customer. The other one start with the product. Apple is a very good example because Apple started looking at what the customer wants. Apple products are one of the most expensive products out there. And a lot of companies try to imitate or duplicate what they have done. But they started with this premise. So they are able to set the price to match the customer's value on what they want. Then they calculate the cost and they create the price. And now all of you who have Apple will realize that their phones are on the top end of the cell phone market. They're not the cheapest. Okay? So this is the way you do it. From small to big companies, try to emulate this. How do you increase profit? What are the key factors of increasing profit?
So Raju, let's ask questions about what you just talked about.
Oh, okay. Any questions on that? On these two concepts, basically two concepts, cost-based and value-based. And we'll have the basics starting from that point. Everything that we cover on pricing starts from those two areas.
So maybe we can ask who's currently doing value-based and cost-based. So, okay, so who's doing, yeah.
Go ahead.
So this pricing is a very challenging place for my business. Before the pandemic, I had a price that was working well, and I didn't have challenge. When the pandemic hit, and I think it was working well because I'm able to go in a farmer's market and actually communicate with the customer. And after talking, the customer would say, I'm sold, this is what I'm looking for. And they just buy and no trouble. When the pandemic hit, we all had to go online. It was a challenge. So we went through the prices through my counseling, and I was told to bring the prices down. And I brought the prices down. I did some sales, but it's been challenged over the profit. So and it's been a challenge really, because even though I brought the prices here, the raw material, they keep going there. So I'm like you said, Raju, I guess I'm going to need help with that to really figure out which way,
Well,
I'm still making profit. I'm still making profit, but like the fees online, the different platform fees they add and this thing, they're all eating into it, and cost of raw material keep going up. So my profit is keeping eating. However, the product is profitable, but in the where I don't just stay around the breakthrough or just over the breakthrough, I want to get, about that.
Sometimes you have to look at it at the other areas, which is the marketing area and the promotion and competitive advantage that you have, or product differentiation that you can create. This is just a segment of the overall business that you are running and you are doing. This is a piece of that business, which is pricing. But sometimes the pricing, the drop of pricing, all of my clients, SBDC and everybody, we all raised prices. Some of them did not go with my suggestion. They took it slowly, but every one of my clients raised prices and they're making more money. It's because most of the small businesses are scared to raise prices. You are scared of your customer running away. And if you raise your prices, they're going to go away. No, you have to provide value. Again, you have to create value for them to say, okay, yeah, I keep buying your product, and because I like the product, there's a difference. So that comes out from the marketing side, that comes out from the operational side, that's a lot of things on the other side. Yes, pricing, your product is going up in pricing, no doubt. Everybody in after the pandemic, the pricing went up on all the materials, whether it be people who's doing bread or to the people who are doing a lot of other products. All of that went up in pricing. Okay. The thing is, I would suggest you to get together with a consultant to help you with this product, but not only on the pricing, but also on the marketing, most probably. Okay.
Right. Raju's absolutely right. Basically, the things that we've talked about in terms of the sales funnel, where you're creating a client instead of a customer, is what will set apart that differentiation, so that you're not being reactive to the market because you've already engaged the proper audience. And we know that the way that we develop, one way to develop the proper audience is through the buyer persona. So everything, and it's a great point, and I'm glad that you brought it up. And Raju, I'm so grateful that you echoed that point. As you can see, even though we're talking numbers now, there are still soft skills and the things that we covered on the marketing and sales side of this that need to be applied when you're thinking holistically about it and approaching it from an entrepreneur standpoint, right? So
yes.
Yes. So especially if you're value-based, there's going to be a big emphasis on the consumer journey, on identifying your target audience, and making sure that you're satisfying, what did we talk about, those pain points, that understanding the niche and the opportunities within your market. That's all part of creating value around your product, not just monetary value, but also value to your customer.
Yes, because the product, the value is there. Before the pandemic, I didn't have problem for the kind of price people were paying for it. So I'm looking forward to getting back there. Thank you.
Is there anyone on the other side who's not doing value, who's not doing value-based? Everybody in the chat was value-based. All right.
Like I said, most of us will be in the value. We are not in the scale of being able to do cost driven, but sometimes we have to. And then this is some of the other topics we'll be covering later on today. Okay, increase profit. You're going to reduce expenses. Obviously, you're looking to get unnecessary costs, negotiate better, collect more of your outstanding invoices if you have improved operation, and make your one-time customer into repeat customer. Exactly what Alexa said. You want to have a client for a while. Your client life value of that client needs to increase. That's, that's marketing. That's where you want to be able to hone on that you want that client always coming, not just one time, And obviously you strategically increase price on underpriced product and services. Again, throughout my whole life, I've always raised my prices, and I'm not scared about raising the prices. Why? Because that is the nature. Everything goes up. I mean, we are not buying bread for the same price that we did 3 years ago, or even last year. Okay, so these are some of the different pricing strategies that you should be considering. These are some basic ones. There's a whole bunch, and there's ways of mix and match all of these together, but at least we're going to give you some so you can start looking at it from different points of view. And you may not use all of it. You may use 1 or 2 of them, and that's fine. Okay. So let's start with penetration pricing. That remember, I think so was Jessica, when you're coming out with a new product or to penetrate the market, or you're trying to penetrate a segment, this is what you do. You give low prices with the hope to secure high volume. Okay, this is chocolate bar, food stuff, things like that you want to try to come up with. Maybe for launching new markets, you do social media promotions, you do all of those things to promote your product. So this is market penetration. That's just one way of pricing it. Again, you still need to know your cost before you do that. Okay, again, we go back to costing. You need to know where you are before you give a number. Value pricing, again, based on perceived value. This is more, and we all see it, luxury brand. What is the difference? Why? And I hate to do, there are $300 and $500 jeans, and as well there are $50 jeans. Both of them do the same function. One has a brand and the other one doesn't have a brand. And we can take the same thing for, since most of you are ladies, I'm going to give the example of why do we want a Gucci bag when we can get a regular nice Coach bag also, okay? Not devaluing any one, but each one fits a certain segment market, okay? So again, luxury brands is an example of value, okay? Loss leader. Sometimes we have to sell something to bring in so we can package it with other products. So sometimes we will give a product that you have to take this with that. So we combine them. That's why you come out with packages. You come out with bundles, if you want to call it. You do this with that, okay? It's usually done at Christmas, and and we want to be able to sell some of the products that I'm not selling. Oh, we'll give you this with that. We'll give you this with that. And that's what you want to be able to observe. But the people who do that, they're using the loss leader strategy. That's what they're doing exactly. Okay. psychological pricing. Well, you're 1999, 999, 1997. We have seen that all over the place. That's the example. Okay. The logic is just under the round number. You know, $9.99 is a good one because everybody looks at $9.99. It's only $9, but in reality, it's 10. They're not looking at it as 10. They're looking at it as 9. Okay. Competitor pricing, going rate. Well, that's what most small businesses do. Most of you and most of us will do that. That's how we come up with the pricing. Oh, my competitor is charging for alfajores so much, so I gotta be charging so much. Doing some, the creams are going for $10. I have to be a little bit cheaper, maybe $9.95 or $9 or $10, and that's how you come up with your pricing and what price to charge. And that's not the right way to price it, like we just showed you. Okay. Predatory pricing, we won't have that because none of us are in that position, but you will see it happen. When Walmart came out and everything, a lot of them were looking at it as predatory pricing, anti-competitive and things like that, when they would look at it from two companies joining together to get other people out of business. That's flooding the market, if you want to call it. But we won't have that issue in Miami specifically. Okay, so we are safe on that one. Now, contribution pricing is what we covered yesterday and today. You're looking at selling minus variable cost, which is your gross margin. Okay, and maybe the best way to, and some people may realize this or may look at it from a different point of view, but the easiest example I can give you is the Toyotas and the Hondas and everything are usually price driven, volume driven, all of that. Yet your Porsche and the other more, the more luxurious brand are gross margin driven. They can't give you as much discount. Okay, so those are the kind of things that you will look at because we're looking at they're looking at gross margin. It's a gross margin product. Okay. And this is where you will use break even and all of the other features that we covered yesterday and today. Obviously, the cost plus pricing, which is what we do, and the keystone of what, how you sell for most of the product. At least I don't want to put you in that position to be cost plus pricing. I hope you're going to do the value driven pricing for your product and your services that you provide. Okay. So now we're going to cover projections. Any questions on the other topics that we did now? Daisy, are we okay? Are we fine today? Okay. I'm not picking on you. I'm really happy about the way you worked out yesterday, everything.
Oh yes, today is a lot better. Yes.
Yeah, okay,
I
good.
actually figured out the answer for 2022. I was surprised I actually got the correct answer.
Good. And it's not, as you can see, it's not difficult. I want you to understand the logic. That's the main thing. Once you understand the logic, the numbers can be brought up by anybody. The plus and minuses and divisions can be done by somebody else. Okay.
Yes, thank you.
Paula, are we okay today? Paula looks like she's sleeping. Okay, so why don't we start with projections?
I'm here.
Okay. Well, let's start with the projection. Why do we do projections? Anybody wants to, I don't like to lecture, but, I know part of yesterday and today was more information. But why do we even want to do a projection? Why spend time even doing that? Anybody?
to make a
Some
better
people
profit,
started it.
have a better margin of sales, better profit.
Yeah, that's correct.
To
Part of it.
always review our goals. I learned recently, well, with FIU to do the cash flow and projections. And at the first time I was scared, like, what I'm saying this, why I'm going, I don't know if I'm going to sell this much, but it's been good to me in these 6 months, or 8 months of this year, because I push myself to the goals that I need to reach.
Right.
So it's been good. It's scary, but good.
Well, maybe the easiest way to put it is you need to know where you're heading, what you need to do to get profitable, where your money is going to be, or what's happening in your business. And you need to compare it to something. You need to have something to base it and say, okay, this is what I need to do, or this is the money. And usually the projections are supposed to be very conservative. Why? Because if you are able to you pass through the most conservative one, then when it's better, then you're obviously making money. Now, what does conservative mean? Conservative means that I am going to reduce my revenue and I'm going to increase my cost. And if I'm still making money, guess what? I'm okay. I'm going to stress the company. Now, whether, a lot of lenders in today's market, especially the SBA and a lot of the other lenders, are forced to look at projection, because 2020 and 21 are very difficult years to calculate, because a lot of business lost business. 22 is a little bit better, but they don't know how to still manage, because they look at 19, but 19 is too old, and 2021 is recent, but pandemic skewed the number. The only number they have is 22, so they have to look at the projections. They're forced to look at projections now. Before they would look at it and they say, okay, fine, but now they are actually taking it more seriously than before, okay? And the SBA requires projections anyhow, okay? So what are projections? And you're going to have internal and external issues. Financial projection will typically take into account internal information, what's selling, what's happening, what came up, how many units you sold. And if you don't have an estimate, or it's a brand new product, you have to do a guess estimate, okay? And we're going to show you how to get started and actually doing a projection. So it's not just talking about it, we're going to show you how to do it actually, okay? So external, obviously, is changes in the market, changes in the climate, whatever's happening, whether it be a pandemic, whether it be we are back to almost normal. And those are kind of things that changing, the interest rates are going up. There's a lot of external factors that affect the business, okay? So it's just a believable estimation. It just needs to make you point out what is possible realistically with your business. Don't go very high, don't go very low, but what is possible. So sometimes we use reliable information based on what you have, reliable statistic, what you have. Oh, last year, in the last 21, I sold so much, 22, I sold so much, 23, I'm going to do this much. Yes, you have numbers to base it off on, okay? And this is where we say benchmarking. We need to see what other retailers or other industry people in your same segment are doing. What are they actually doing? How much of it is happening compared to somebody else? So you say, okay, there are information available that you can pull out, and you can see if you're on the right track or not, or it looks believable, because lenders will use those same platform and resources to get an idea on your business. There's no way we, as a person, can know, as an underwriter or as lenders, know all of the businesses. So we have to use resources. So we'll give you some of these resources to you so you can start comparing yourself to other ones. Doesn't have to be, you could be better in certain things, off on something. That's okay. But you know what everybody averagely is doing. You get an average of your industry. Okay? So how do we start? You say, I'm going to sell lunch so much, dinner so much, drink so much, you know, units. Okay? Every month, how many units you're going to sell? How much that unit is going to cost. So if you have multiple products, you come up with an average on that segment. Not all earrings are going to cost you the same, but you can come up with an average price of the earrings. You can come out an average price on that lunch menu. You can come up with an average of that dinner menu, and so forth. So you do come up with some averages, and you, since those are assumptions, you do put it underline them. Hey, I'm assuming this much for lunch. I'm assuming so much units for dinner and so forth. And obviously, what price you're going to sell each one, average. My lunch is going to be $25, or this is going to be $10 or $10, whatever it is, price. And obviously, the multiplication of these two, if you multiply these and this, you'll get this number. That's it. It's real simple, real straight. But you do have to define how much units and the price that you plan to do an average. And that will give you your sales. Okay? Now, you need to know how much this one is costing you, and that's your cost here. How much this is costing you, and that's your cost here. Okay? And where does this number come? Guess what? I'm saying I'm using 187, 376 out of that. Okay? This is where the cost is associated with this. This is the direct cost of each of those widgets. Okay? And that gives you my total numbers on that. 40% of my cost is going here and so forth. Direct cost of sales. Now you have also other costs that may be directly, and well, other costs like shipping or the fees that you all have, maybe other costs that you may want to do. But this number is this times the units here. That's the number you get. So as you can see, this is, mind you, there are hundreds and thousands of spreadsheets available on this, on Google. All you need to know is this number, you need to know this number, and what are the direct unit costs. 3 pieces you need to know. The rest is done for you. You don't even have to figure it out, okay? Like I said, you have a conservative versus aggressive scenario. You do 2 of them. Separate business lines if you can. If you can't, don't worry about it. It's okay. You don't have to. If you do have it, you may have to do it, okay? Historical use forecast on units, market size, customer order, whatever information you have or able to gather from your business. That's why I say getting into any business, you still need data, you need information. And these are the things that you need as any business owner. Well, I can sell so much, I can do so much. You need to be able to be realistic on what that number is. You know, you have to be conservative. I prefer you being conservative over being aggressive, okay? Obviously, step 2, estimate expenses. You do have your variable expenses that we cover, cost of goods sold and direct labor. You do have to break it down. Okay, your fixed overhead is like the example we did for the break even. Rent, salary, marketing, professionals, all of that. Okay, so if you see the formula, the format does not change for any of these things that we covered yesterday and today. Yes, Paula, I'm sorry, I just saw you, Paula. Where did you go? Paula was there. She had her hands up.
Yeah, maybe she was in her car. Maybe she will connect in a
okay,
minute,
okay.
Raju.
Okay. Yeah, no, I just saw it and then, okay. So what you want to do is you have to estimate your expenses. Even if you're starting a business, you do need to estimate how much is my light going to be, how much is my insurance going to be, how much is my telephone bills are going to be, and utilities and all of the other things that go with the business. You still need to come up with an estimate on what your business is going to cost you to run. This is what we call the cost of running your business. This is the piece that for every product you sell, this is what goes directly out. This is your 65 cents in the cup of coffee example. Okay. Now, where do you get some benchmarking? How do you compare yourself to somebody else in the industry? The only one I've been able to get is BizStat, which is free. But the reason it is free is because it's dated. They may give you data of 5 years ago or 6 years ago. That's why it's free, because they want you to subscribe to their platform to sell you that. So, but for most small business guys like us, you know what? BizStat is fine. We don't need up to the minute or last year's numbers. We would like to get it, and you can. Now in the library, you can get some of these and you can get it. Or there is an RMA also that you go to the library and you can look at it up. But it's a reference book, so it stays there. So you can go there, look for your NIC code, make copies of that, and you take it home. But you have to go to the main library. It's a little bit expensive. So, bankers and lenders do get it because that's their business. But for us, as small business owner, as long as we know what's happening in the industry, we should be fine. Okay? Okay. So this is the only one that I know that is free. I use it myself. So I use it when I have to look at certain industries. I look at it and it gives me an idea where that industry is or those types of businesses are. So even I use this one, okay? This is how it looks, more or less, just to give you an idea. This is how it kind of looks. Nice, it's all numbers. Safely, you see more numbers. There's a lot more numbers. And mind you, the reason is, and these numbers, all of these numbers, I want you to understand, all of these numbers that you see here are percentage. That's why when all the examples we did up to yesterday and today, all I did was worry about percentage. I don't care for the dollar amount. I care about the percentage. I'm looking at percentage. All of this, the salaries, 1068, rent, 2.4, taxes, all of that. Okay? So this is a percentage. Doesn't mean that it's your business, could be, different types of business, okay? But it gives you a percentage. That's why all we do, everything we analyze is based on percentage, not the specific numbers, okay? Because it could be different. And the numbers can even be more different if you were in South Florida, as opposed to being New York, as opposed to being California, or even being in Nebraska. Okay, so the numbers can change even within a region within the US. Okay, so just to give you an idea, and mind you, just take this as with a grain of salt, because it just tells you what's happening combined. It's an average. It's not one company, it's a combined average. So you can get into really difficult if you want to base it on, but it gives you an idea where everybody is, more or less. Approximately, okay? Obviously, you're going to track the projections. You need to put it into it, and you compare it to what you actually did. Just like somebody mentioned earlier today, you want to be able to look at it and see if you're on the right track. Why do we even do projections? We want to be able to compare to what we are doing. You want to have a comparison where we want to be. Are we on the right track? Am I selling what I'm selling? Is my cost the right cost? Is my overhead correct? All of those things just to confirm that you're on the right track. And that's why you will be able to make profit, more or less. Okay? If you're making profit every week, every month, guess what? At the end of the year, you are going to make money. Now, the other piece that they mentioned was the cash budget. You do need to know cash. You do need to know what's going on. Cash. One is what you're selling and everything. The other one is actual money in and out of your business. Actual cash going out of business. There are a lot of businesses that are profitable, but very cash poor. They don't have the cash. You don't want to be one of those. You want to be able to be profitable and at the same time have cash. That's why one of the points that we covered yesterday was the statement of cash flow. Where's, you made a profit of $50,000. Where's the money? Show me the money. This is why you want to be able to keep a cash budget running and having it with you. Okay. This is how cash sales projection. This is what you should have got on Wednesday or Thursday. You should have got this. Okay. It shows you, as you can see, we did for the Zen Flower Shop, we did, this is how much they're selling every one of these products to different clients, how many units, and this is the revenue that they're generating at each one. So at the end of the year, they're going to sell $76,000, $77,000. Price is $90, 855 units for the whole year. Okay, this is what they're projecting. This is what they're projecting for B2B. This is what they're projecting B2 government. B2G is business to government. Okay. Now, as you can see, we also do the same thing for the cost. This is, we find out that it's 17% last year, percent of sales of last year. So we took last year's number to come up with these numbers. So we are projecting it to be this for the whole year. Based on last year's number, based on these sales. Okay. This is how we come up with it. Now remember, this is an estimate. It could change. Maybe in May, prices went up. You have to adjust accordingly. Okay. Maybe you are, you can't charge $90 here, and now it's $80. You have to make the changes. Okay. So these are the things that you as a business owner needs to come up with. This is very important on the top side, which is the sales and cost. That's what we covered in the how to get started. Those are the two keys that you need to do. Okay. Oh, I must have, there was a slide that I must have, which is, I wanted to show you how the projection looks, the whole projection. Sorry, I gotta to have a couple of minutes to get that in, but this is what I wanted to calculate your units per day, per week, per month. As you can see, this is the units that you're trying to calculate. Units sold here, units sold here, units sold here. And I want you to sit down with your SBDC consultant or whoever your consultant is or advisor is to come up
Raju,
with
some
these
of
numbers.
them are in the Business Navigator. So either with Navigator or with the SBDC, you have
Okay.
option to a financial consultant.
Right, yeah, that's why you need to make sure that these numbers are correct. Okay, these numbers are true. The pricing may change, obviously, because your pricing, you may give discounts, you may give incentives, you may give, So the thing is, but you need to make sure that the units and your costs are correct. Okay, because we tell you where you're going to break even. Now, if you give me once, I will stop sharing for a minute if it's okay. And I'll bring
Yes,
that.
go ahead,
I
Raj.
want to add the slide, or it's in there, but I want to bring it up, which is the actual projection for Zen, the full projection, which you got it on Wednesday or Thursday. You did receive it, but I wanted to bring it up to show it to you as how it would look, the whole piece, so we can share it. Okay.
Yes, go ahead, Raj.
This is how it looks. Those final numbers. This is what it came up to be. The revenues from all three segments, the cost of each, the gross profit. This is your overall expenses that you have. All of these are expenses. This is your cost of goods sold per month. This is your profit, total expenses and profit before taxes. And as you can see, it's changing. It changes every month. These months they made, you had a loss. Okay, this month you had a loss, but the other months you were fine. And it depends on the time of the year and everything, that each one, depending on the business. Okay, as you can see in the projections, if you remember the previous example, this one was 51%, now it's 68%. Where she plans to hire more people, okay, and she's going to have outside services went up tremendously from the previous year. So she's projecting that I'm going to get more help, because I'm going to sell $200,000 and I need more help. Okay. And she's going to spend more money in marketing. So this is how you do a projection. This is numbers that you estimate in dollars. This is on the percentages. So she planned to sell 207 when in her previous year she did 168,000. So she's going from 168 to 207. And she's still going to make a profit, but less than the previous year. Because she's going to reinvest more into the business. Okay, so this is how you kind of look at it, how you want to be able to expand your business. So if you had to calculate what is the break even for 2023, you have the numbers here. Anybody wants to take a shot at it?
Please repeat the question, Raj, for everybody.
Yeah, it's right here. What is the break even for 2023? Remember, you take this number, you're going to divide it by anybody wants to tell me the number?
68.
How much?
68%. 68%.
No. Take this number, 140, and you divide it by?
Raju,
Yeah.
I have
84,000.
I have 1,846.77. Is that what it should be?
222.
Yeah, 184,677. You're correct. Sadie.
Yeah.
Now, the next question is, which month does Zen reach break even? Which month? How will you calculate that? And there's a very simple answer to that one. And you're gonna, if you see me on the street, you most want to you want to throw me out under the bus if I tell you how to do this.
Wait. 1917%. Wait.
All you do is multiply or add all of these months. And I think so you get to October. If you add the sales from all of these months, the simplest way to do it, you have the spreadsheet there. You don't have to do, just add all of these months. I think so it's right on September, October. Could be part of November, but I think so I did it.
Raju,
Yeah,
I have a question. So to get the break even number, you did 16,988 divided 76%, or I'm wrong?
no, I took the 140
140. Okay.
and you divided that by 76. Remember, that's your total expenses, correct?
Okay.
Remember, break even, I didn't make money, I didn't lose money.
Yes.
So I have about 17,000. So basically, I bet you it's right on November. So you add all of these months, you should be very close to the 184,000. Was it 184 and 700 or $600? Okay.
Okay.
Okay, let's share if you have questions with Raju. And Raju, thank you for being so patient with all the questions and to make all of us feel comfortable to ask everything we needed to ask.
Any questions or any?
Yeah, I have another question if nobody has. If you have to say is good for you to grow this amount of percentage by year, how much it will be? Let's say if your business grow like 10% or 20% each year, that means you are in the right direction. If you grow less than that, you're not doing so good. How much will be that percentage?
There is no perfect answer. Again, yes, you do need to grow. And then we have what we call our organic growth. Organic growth comes out from your gross margin. How much you remember, gross margin tells you how much you are able to grow. Well, that's the number that you are able to. Part of the other piece is net profit, how much I'm making. Based on this example, as we have it here, she only made $16,000, $17,000. She has, remember, historically, in 2022, she made $40,000 profit. Okay, this year she's only making $17,000 profit. So she's not able to grow as fast as before.
Mm-hmm.
She's not going to be able to, but she doesn't have the money to keep growing. So even though she made the same amount of money or projecting to make the same amount of money, her expenses are going really high. Okay, she's spending a lot of money on certain aspects, specifically here. So she's spending money because she wants to grow the business, she wants to do it. So that's this year she's spending a lot of money in that. Okay.
Yeah.
Okay, and so that's why it's not as easy as saying, okay, yeah, organically, 22 to 23, she can grow quite a bit, but 23 to 24, she's going to be able to grow less because she only had $17,000 right now available.
Mm-hmm. Yeah.
Now,
But
cash flow wise,
Raju,
that's why you do the cash budget, because give you a different number also. Okay.
but I think also in the first year she started paying her salary late. No?
Correct. Now, we don't have the full story on Zen, but in Zen, she paid herself this much money, but she also took $25,000 as distribution. She took an extra $25,000 or $30,000, which is not here. Okay, it's not here. She took the money from the business. That's it, it's gone. So cash flow wise, the money is gone. So she, at the end, she has, cash wise, she's very tight also. So that's why she's not able to grow as fast. So remember, this is just one piece, like I said, from yesterday and today, this is just one piece of the whole picture. You can't decide the whole picture on this 1 or 2 or 3 dots, okay? But I want you to understand that, yes, growth is going to be very slow here for 23, 24. 22, 23 was going to be strong, and that's why she's doing that. She's able to grow here. Now, if you did the projection for 23 and 24, you see the increase is going to be smaller. Okay? So there is what we call organic growth, and there is also inorganic. And inorganic is I go borrow money. I go borrow money and I'm going to raise my business to the next level. Then yeah, you can grow 30%, 40%. Organic is I'm not borrowing any money. I'm just using whatever my business is doing, regular business day to day. I haven't borrowed money. I haven't gotten any new money. I'm just using what I got.
And when I say the business navigator, the business navigator is like a sibling of the SBDC for now. So once you register with the business navigator, it's super easy for us to place you in the right place. And you can have the meetings with the financial consultant. So it's just to submit really 5 questions to start working with them. So don't forget to do it. Any final questions for Raju, comments?
I had a quick question.
Mm-hmm.
Okay, Raju. So, of course, Christmas and Thanksgiving and Black Friday is coming. And so we have to start getting prepared for that. And so in utilizing the projections, let's say for that, would you say it's important to focus on the units so that we don't run out of products and so on for that time of the year?
Well, obviously, you would have to estimate how much units you're going to sell, obviously. But also, like we showed it yesterday and again today, unit is not the only factor or only variable. You also need to know the pricing on that. I may drop my pricing, and I'm hoping that I'm going to raise the quantity. So if it's a pendulum. Which way do you want? You can't have it both ways. Sometimes you can. If you do, then you're great. Obviously selling for more and selling more pieces. Great, you got both. Sometimes you need to kind of weigh which way you want to do. But also, if you're going to buy more units, it's going to require more capital from you to have those that much amount of units. So sometimes you might raise your price. So yes, you will sell what you got, but at the same time, you're getting more for each product. Again, your branding, your marketing, all of the other aspect of the business will dictate what kind of clients you're going to get. Who's your target market? Who's your end user? And are you going to be selling, and your marketing is being done, in more efficient way to maximize your customers. You understand?
Yes.
And I would say, Stacy,
yes.
Sorry, I want to add something. That is a very good time also to get rid of inventory that probably you are not selling. You can create packages, or you can reduce the price for those things that, I mean, based on what Raju explained today, but adjust the price so you can get rid of real inventory that is kind of stuck too.
And not only that, to that point, remember what we discussed in Deetra's class around understanding your supply and demand. So utilize that knowledge as part of your strategy and your overall business strategy to see where you can make those changes, and then apply the pricing and sales knowledge that Raju has given you all.
Yes, thank you.
You
And
don't
one
have to
more
sell
thing-
a ton. You don't have to sell a ton to make money. You just have to sell enough to make good money.
Yes. Last year I ran out of something, so I don't want to be in that position this year. So I
Well, if
want
you
to
have any
utilize
leftover
this
inventory-
projection effectively.
Remember, if you have any leftover inventory, you're going to be landing up giving specials on January and February.
Yeah.
Uh,
Right?
Yeah.
And also, what would you say would be, do you have any recommended tips? You know, as small businesses, we may not necessarily be able to liquidate as much as bigger companies for Black Friday. So, you know, we may not be able to do like 75% and things like that. But what would you say would be an effective strategy that we could employ to still take advantage of the holiday, but not lose as much profit?
Well, if you see, even based on the pricing strategy we talked today and showed you the different methods, if you see, they don't, when the Macy's of the world come out with specials or pricing or discount, it's not across the board. They're just doing it in pieces. You know, they're using segments. They're not using all of it. You know, you don't walk into the store and everything is 75% off or 50% off. Yeah, this thing is there, the brand items are not. So they are very strategic in the way where the discounts and the promotions are. But guess what? You can do the same thing. You don't have to give it across the board. You know, remember we talked about the penetration, or we wanted to talk about combining and, okay, I'm going to give you this for this, but you got to buy something else with it. So there are different methods of actually selling. I mean, even during the Pandora, the bracelet, they have a promotion usually around September. If you spend, I think so, $150 or $175 or $150, something like that, or $125, they give you a free bracelet. Okay, they're giving you something, but you got to buy other things that go to that. So it's not, you have to understand, there is all of these strategies are created, but small business look at it across the board. You don't have to do it across the board. You can pick and choose. Oh yeah, this one is available at this price, but not this, you know? And that's how you kind of, you know, combine it. I mean, even whether it be hair salons or this, they all use different kinds of promotion to get additional business. Okay, is which one fits, and you may not use the same thing every month. You might be using different. You might be rotating product lines. You might be rotating services. Okay, so a lot of it depends on the strategy for your marketing, and usually you want to have a marketing plan set up for months. You know, this is what I'm going to do in January. This is what I'm going to do in February. You know, obviously, you know, in jewelry, Valentine's, Mother's Day, and Christmas tend to be the biggest sale. So obviously they will put a lot of different promotions in those months. The rest of the month they do promotion, but they're not as big. Okay. So you have to look at your sales, you have to look at your product, and you have to see when is your peaks and valleys on those for your product.
Yes. All right. Thank you so much.
Okay. It's okay for me to stop the share, right?
Yes. Raju, thank you very much for all your patience with all the questions.
No, it's
to
a
repeat
pleasure.
for
No,
us
I'm
a lot
glad.
of the lessons so everybody gets it super clear.